Are you thinking about adding a self-directed IRA or a self-directed solo 401k to your retirement planning? If so, then you might be wondering which of these two options is the better one. In today's video, I'm going to be breaking down everything that you need to know about investing with the self-directed IRA versus investing with the self-directed solo 401k. And make sure you stay all the way into the end of this video. I'll be going over one piece of golden information that you're not going to want to miss. Let's get started. All right, guys. What are self-directed IRAs and self-directed solo 401ks? Before we go over the advantages and disadvantages of each of these investment vehicles, let's first quickly go over what they are. Self-directed IRAs, also known as SDIRA, is a type of individual retirement account that is similar to a regular individual retirement account or IRA. However, this is one of the big differences that I want you to understand. With a self-directed IRA, you will be able to include certain types of alternative investments in the account that you would not be able to include in a normal IRA. For example, a regular IRA only allows for you to have stocks, bonds, mutual funds, and few other relatively common investments. However, with a self-directed IRA, you can include alternative investments such as real estate, shares of privately held companies, precious metals, and much more. But would you still need to have a trustee or custodian to hold the assets on your behalf? Let's talk about this. You see, self-directed IRAs are called self-directed IRAs because even though a custodian or a trustee administers the account, it is still managed by the account holder, aka you. Self-directed IRAs are available either as traditional IRAs or as Roth IRAs. So, with a traditional self-directed IRA, you make tax-deductible contributions, and with a Roth self-directed IRA, you take tax-free distributions when you cash it out during retirement. So basically, self-directed IRAs are very similar to normal IRAs, except you have the ability to add a wide variety of assets into them, giving you much more control. Let's talk about self-directed 401ks. You see, with self-directed 401ks, these are also an alternative to regular 401ks. Like self-directed IRAs, self-directed 401ks allow you to invest a wide range of assets. For example, with self-directed 401ks, you can invest in all of the following assets, including stocks, bonds, mutual funds, real estate, tax liens, private placement deals, precious metals, energy investments, equipment leasing, and even foreign currency such as crypto. However, even though self-directed 401ks allow you to invest a wide range of assets, there are still some assets that you're not allowed to invest in with self-directed 401ks. For example, you cannot hold collectibles such as artwork, baseball cards, or antiques inside of a self-directed 401k. You also cannot hold insurance inside of this as well. Now, self-directed 401ks come in traditional and Roth options, just like self-directed IRAs. Also, with self-directed 401ks, you are responsible for managing the investments, even though another party will hold the assets on your behalf until you cash them out. Now, the question I get asked all the time is who can open self-directed IRAs and 401ks? Almost anyone can open a self-directed IRA. You just have to have earned income, a copy of a government-issued identification, and a debit or credit card to pay for the account establishment fees. The rules for self-directed 401ks are completely different. Only business owners who do not have any employees can use self-directed 401ks. However, people with self-directed 401ks can use the retirement plan to cover their spouses too if they would like. So this creates a bigger tax deduction and also boosts retirement planning. But what are the pros and what are the cons of using self-directed IRAs and 401ks? One of the number one pros to using these types of accounts is the advantage of self-directing the money. This gives you more freedom and more control over what you can invest in. So if you're someone who prefers to invest in alternative assets, or if you are just someone who likes to control how your money is invested, then either of these options can be great for you. Additionally, self-directed IRAs and 401ks have many of the same tax advantages as their regular alternatives. So you will not miss out on the tax benefits of 401ks and IRAs if you go with the self-directed options. But here are some of the cons to be aware of. Some people consider self-directed IRAs and 401ks to be a higher risk because they are self-managed. In other words, unless you are an expert investor, picking the assets that go inside of your 401k or your IRA can be a risky endeavor. But there is also the potential to generate higher returns if you do know what you're doing. Another potential con of self-directed IRAs and 401ks is that they have a little bit higher fees. One of the reasons why this is the case is because people who have self-directed IRAs and 401ks often make many trades and add many assets to and from their IRAs all of the time. Over time, the fees associated with making these trades and adding assets to the account, they'll start to add up. So what are the key tax differences between self-directed IRAs and self-directed 401ks? When it comes to self-directed IRAs and self-directed 401ks, there are two particular taxes that are highly relevant. The first is the unrelated business income tax, which is commonly referred to as UBIT. The second is unrelated debt financed income tax, which is also known as UDFI tax. If you've never heard of UBIT tax and UDFI tax, I really want you to pay attention. So let's quickly go over these. The first one I want to talk about is UBIT. UBIT is a tax that is levied on unrelated business income generated by a tax-exempt entity, such as an IRA or another tax-advantaged investment account. What this means essentially is that if your IRA invests in certain ways, then it can be subject to taxes even though it is a tax-advantaged account. Only certain activities are subject to the unrelated business income tax. The IRS does not apply a UBIT to passive income or income from investments from rental properties or interest income or dividend income or royalty income, but it does apply UBIT to active income investments such as debt financed income, unrelated business income, and income generated from an unincorporated active business. So, as a rule of thumb, if you invest in private active businesses through your IRA, you can expect UBIT to be paid. Okay, I don't want this to be a shock to anybody. Okay, so the next question you might be asking is, does this unrelated business income tax UBIT apply to just self-directed 401ks or just IRAs, or is it both? The answer is it is both. However, just like with self-directed IRAs, UBIT only applies when investments in private active businesses that are not C corporations occur. So for example, if you have a solo 401k, which is another name for a self-directed 401k, and if you invest in a local restaurant and you receive distributions from the restaurant as a part of your investment, then unrelated business income tax would apply in this situation. Your IRA invested into a business, you have unrelated business income taxes associated with that. Now, what are these UBIT tax rates? This is something that I had to spend some time studying, and I want to make sure that you really understand it. The UBIT tax rates are between 0 and 37% based on the amount of unrelated business income you have. Now, UDFI is a little bit different. As mentioned earlier, UDFI stands for unrelated debt financed income. UDFI is a tax that applies to income generated through an IRA in which debt was used to finance the purchase of an asset that produces income, aka like buying an investment property. For example, let's say that you use debt to finance the purchase of a piece of real estate that you put inside of your self-directed IRA. This would be an example of debt financed income that would be subject to UDFI taxes. Self-directed IRAs are subject to UDFI taxes, but what about self-directed 401ks? This is actually one area in which self-directed IRAs and self-directed 401ks are so different. Self-directed 401ks are not subject to UDFI tax. So if you're planning on using debt to finance the purchase of an income-producing asset that you want to place inside of your retirement account, which is something you can do, you can have assets inside of your retirement account that don't revolve around stocks, it can be real estate, then you might be better off with a self-directed solo 401k so that you can escape the UDFI tax. Now, what are the rates for UDFI tax? Like UBIT, the tax rates for UDFI range between 10 to 37% depending on the amount of income you're earning. The more money you generate through your investments, the more taxes that you'll pay into UDFI. But the question I get all the time is, how do I avoid UBIT? How do I avoid UDFI taxes? Well, you can avoid UDFI taxes altogether by having a self-directed solo 401k instead of a self-directed IRA. However, some people do not have the option to have a solo 401k, and thus they cannot avoid UDFI taxes by choosing a 401k over a self-directed IRA. Generally speaking, the best way to avoid both UBIT and UDFI taxes is to simply only invest in passive income assets and to avoid active income investments. In other words, It's pretty much like utilizing Robert Kiyosaki's cash flow quadrant, where he's teaching you to go from, trading in your time for money, being in the E quadrant, and making your way down to the I quadrant, where you're investing in passive assets that give you your time back. In other words, whether you have a solo 401k or a self-directed IRA, you can avoid UBIT and UDF taxes by investing in things like stocks, mutual funds, precious metals, and of course, foreign currency. If you're someone who would prefer to invest in active businesses such as restaurants, retail stores, construction businesses, then it would probably be a good idea for you to speak with a tax professional in order to learn about how to minimize your UBIT or how to minimize UDFI taxes. Many people find out later about UBIT and UDFI taxes, and it becomes really complicated and unfortunate because they already purchased an asset inside of their IRA or inside of their 401k. And they're not taking that back out, are they? A lot of people make mistakes as a result of not understanding just these two taxes. Now, you can prevent mistakes by consulting with a tax expert who can provide you with guidance for these tax issues. But please do not go to your CPA assuming that they already know what these taxes are. You need to go to a specialized tax professional. Now, what tax forms have to be filed? If I'm going to be doing anything with my IRA or with my self-directed solo 401k, is it different now if I have UBIT or UDFI taxes? The entity that is administering your self-directed IRA or your solo 401k should file what's called a Form 990T on your behalf to report any unrelated business income you might have. Now, this entity will also be required to pay the taxes from your self-directed IRA or solo 401k on your behalf. In other words, you're not going to have to pay the UBIT or UDF type taxes from your personal funds. They get paid straight out of your retirement account. Karlton, how does that work? Well, your retirement account is the one that's purchasing the assets. So your retirement account is actually the one that has to pay the taxes, not you. Some people view this as a good thing because it means they won't see their bank accounts dwindle. But other people view this as a bad thing because it essentially takes capital out of your self-directed IRA or your solo 401k. But regardless of how anyone feels about it, those are the rules and everyone has to deal with them or leverage them. So let's jump in. How do you open a self-directed IRA? Now that you know what to expect in terms of taxes for self-directed IRAs and 401ks, you probably have a better idea whether or not you would like to have one now. If you do want to open one up and take matters into your own hands to plan for your retirement, we should talk about the steps that you're going to need to complete. Step number one is you're going to need to find a custodian or a trustee for the account. In order to open a self-directed IRA, you'll need to go through an official custodian or a trustee for the account. This custodian or trustee will manage the funds on your behalf and pay the relevant UBIT taxes using that Form 990T from your account. Not all major brokers and not all financial institutions offer self-directed IRAs. You might want to do a little shopping around ahead of time before the end of the year if you're trying to get a tax deduction. Now, step number two is choose the investments that you would like to place in the self-directed IRA. Keep in mind that the investments that you choose to go into your IRA will impact whether or not you pay UBIT or UDFI. However, keep in mind that the better your investments are, the more money that you will have in retirement. So even if you have to pay UBIT or UDFI taxes, that does not necessarily mean you should just completely avoid these investments altogether. It could end up leading to potential higher gains than you investing your money into the normal market. Step number three, make sure that you carry out any due diligence needed for the investments. As a self-directed IRA holder, you have a large amount of responsibility to make sure that the investments that you put into your IRA are sound. So make sure that all due diligence that is required to be done is done before you decide to add the funds or invest in that account. Now, step number four is just ask the trustee or custodian to carry out the desired transaction. Once you have completed all the other steps, then you can start adding assets to your IRA and saving for retirement in a tax-advantaged way. Hopefully, over time, your IRA will grow and grow and grow, and your investments will be extremely successful. I'm praying for you. But by the time you're ready to retire, your IRA will help you to have the retirement funds, hopefully, of your dreams. But here's how to open a self-directed 401k, because this is a different process than IRA. The process of opening a self-directed 401k is similar to the process of opening an IRA. However, to open a solo 401k, you'll need your employer identification number. This was also extremely important because I talk about the EIN number all the time on this channel. You'll need a plan adoption agreement and you'll need an application. You'll have to provide all this information to your custodian or your trustee. They'll help you fill it out. If you are approved, then you can start putting assets into your solo 401k immediately. Now, what are some of the limits for the self-directed IRA that maybe are not there for the 401k or the limits that the 401k have that the IRA may not have. For self-directed IRAs, the contribution limits are actually the same as for regular IRAs. So for 2023, this means that $6,500 for people who are under the age of 50 can be put into IRAs, and $7,500 can be put in for people who are over the age of 50. Karlton, why is it that you get to put in more money if you're over the age of 50? Obviously, the government wants to help you plan for your retirement if you're over the age of 50 by allowing for you to put in $1,000 more. So for solo 401ks, the contribution limits are $66,000 if you're under the age of 50 and $73,500 if you are over the age of 50. Maxing out your self-directed IRA or your solo 401k contributions each year is a great way to save for retirement and to help yourself live a little bit more comfortably in retirement while also reducing your tax bill right now. However, not everyone can afford to max out these contributions. After all, most people have many bills to pay and are reinvesting that money back into things that can also produce a better return. But even if you do not max out your self-directed IRA or your 401k every year, this doesn't mean that you can't still make significant contributions to one or both of these accounts every single year. Just do the best that you can. And hopefully by the time you reach retirement age, your account will have grown substantially because you are a smart individual and you're utilizing the tax code effectively. Maybe it'll even be worth millions. Now, as promised at the beginning of the video, here's the golden piece of information I wanted to talk about. Many people investing in cryptocurrency would like to make it part of their retirement plan, but they don't know how to do that. Well, here's an interesting fact. You can actually add cryptocurrency to your self-directed IRA or your solo 401k. That's right, guys. All you crypto investors that follow me, the government actually allows for you to add cryptocurrencies like Bitcoin, Ethereum to these retirement accounts as alternative investments. This will be music to the ears of people who have possibly believed that cryptocurrency could be the future of money. Well, if you do believe that, why not invest in it through an IRA or through a 401k? Those are options that can provide you with tax savings. However, even though the government allows you to place cryptocurrency inside of your IRAs and solo 401ks, that doesn't necessarily mean that you should just only add cryptocurrency to these accounts, or even that a large percentage of your account should just be cryptocurrency. After all, cryptocurrency is still very volatile. It can still be extremely difficult to predict how long or how short-term price movements will impact you. So you just need to be very smart. But with that being said, adding some crypto to your self-directed IRA or your solo 401k could be a good way to diversify your account. Just make sure that you do all the due diligence before you start adding any crypto to your retirement accounts. If you would like any help in organizing how much you should be putting into your self-directed solo 401ks, your self-directed IRAs, in combination with all your other strategies, with the Augusta loophole, with you taking your home office, with writing off your vehicle, this is another strategy you have to take into consideration. Then you need to speak with a tax professional, and I look forward to being that tax professional for you. If you're interested in working with me and my team, you will see the links below this video. We place them at every single video, so you have the option to work with us. But if you're not ready, then I encourage you to go through our library of all this other content we have for you. We have so much content around LLCs, S corporations, C corporations, placing your children on payroll, and most importantly, my favorite, utilizing real estate to offset W-2 and 1099 taxes. If you're somebody that's thinking about jumping into that strategy, I highly recommend that you don't do it alone. I have the program Tax Alchemy below where I'm coaching everyday taxpayers like yourself. You're a W-2 taxpayer and you need a community to be in where you can learn how to buy real estate with other people that are learning how to buy real estate, and they're using that real estate to offset their W-2 taxes. And this is the community for you. I look forward to seeing you inside of Tax Alchemy. To everybody else, thank you so much for making it to the end of this video, for being an avid follower of my channel. If you could do something for me, go ahead and hit the like button. Go ahead and hit the subscribe button if you haven't already, and I'll see you guys all on the next video. Cheers.